of Roundtable Prime.
All right, everybody, welcome to the third edition of the Roundtable Prime here live from the Los Angeles office at DoubleLine. As Jim was reminding me, we've had a live version, we've had a completely remote version, and now we're having a hybrid version with our guest today. So thanks, everyone, for taking the time to make it and join us today. What we want to start off with is what's on everyone's mind, and that is what is going on in financial markets. And let's look at dig into some of the economics data. So our first segment is really going to focus on what's going on from the macroeconomic standpoint, and then we'll transition to markets. And lastly, we'll talk about how to execute on some of these ideas. So starting off with the macroeconomic landscape, Jim, why don't we start with you? You're a big Fed watcher, as I've seen you be attributed for. And the mantra in my career has always been, don't fight the Fed. Right. And so the Fed's been extremely accommodative. Right. We know with the QE policies, very ultra low interest rates, very aggressive in both of those in the pandemic. So does the Fed still have our back? Because the Fed is now transitioning from the quantitative easing standpoint to tapering their purchases. Rate hikes are on the table. Bond markets are going to price those in. So what do you see with the Fed doing in 2022? And should investors try to fight the Fed? Should they welcome the Fed? And where is the Fed put today?
Yeah, it's a good question, by the way. Thank you for having me, because there is a dynamic that's changed in the last year or so that makes it a little different than what we've seen over the previous 13 years. That dynamic is in political polling. The majority party, and I want to say that in a nonpartisan way, because if it was the other party, it'd be the same, is not polling well. And when people are asked, what are the biggest problems in the economy, prices and inflation are now replacing COVID is number one. 40% of the country rents and has less than $1,000 of savings. They are very unhappy about inflation. So now the Fed has got an interesting juxtaposition, because in the past, whenever they would deal with financial market instability, you supposedly had both sides on the same camp. You know, if you pumped up markets, everybody was happy. If markets went down, everybody was sad. Well, now you've got a position where if you address what the 40% want, you might make markets unhappy. If you acquiesce to markets, you might make the 40% unhappy. How do I know this? Because we are getting stories, several of them, as a matter of fact, that the administration, for the first time since Jimmy Carter, is asking the Federal Reserve to get more hawkish. Do something about inflation. The Fed told us for a dozen years, going back to Bernanke's famous 60 Minutes speech, we have the tools to deal with inflation. We could deal with it in 15 minutes. Okay, it's here. You've got the tools. Use them, is basically what they're being told. So they're in a tough spot, because that's the other side of the equation. It isn't just, oh, pump up markets and everybody will be happy. Or if markets fall, everybody will be sad. Yeah. So
I told someone that too, when you talk about that they have the tools to do it. They could hike 300 basis points. They could hike 400.
You have a Saturday night massacre.
Yeah,
right? Yeah.
Sure.
It could
you
be.
Want me to end inflation? Watch this, right?
Yeah. If you think about it, and I'll take this one to you, Jim, and you think about what's happened with all this money supply and all the growth out there, and then we look at the reverse repo that's sitting at the Fed. Right, we've seen a huge drawdown in the last week or so. I know you watch this very closely, and it was a harbinger of bad things to come back in 18, right, where people were parking money there. But to Ed's point, this loan growth, right, banks weren't making a lot of loans because we were all awash with cash. Whether it's the consumer, corporate America was able to borrow very easily and cheaply out there and extend out maturities extremely long into the future. So what do you make of what's going on in the repo market today? And is there something that people are missing here? And is that going to bring more loan growth as we think and we move further into 2022?
Yeah, I think the simple answer with what's happening in repo is that the banking system is awash with money, and they don't know where to put it. And the Fed is here promising you 5 basis points, no questions asked. And a lot of it is going into repo. And by the way, the indications are, because there's no hard data, that about a third of that is the top 4 banks. So it's very heavily weighted towards the JP Morgans, the Citis, the Wells Fargos, and the Bank of Americas as well, too. So that's where they're parking a lot of their money. Where it goes to is this idea that we've talked about here a little bit, is this money's not making its way into the real economy to the extent that we want to, but it is making its way into financial assets. And if it's going to help to depress interest rates, if it's going to help to keep the liquidity going, you're going to continue to see it push up financial assets as well, too. And one quick thing about financial assets, I want to add to what Jeffrey said. So if you take out the FANG stocks and the market hasn't done anything since the beginning or end of 2019, there's a narrative that the stock market's up a lot and it's telling you that everything's okay. What's that narrative when you take out the 5 stocks? That narrative, it's not that it's bad, but all of a sudden the story gets a lot muddier at that point as to whether or not financial markets are validating some idea that we're going to have very strong growth because it's so concentrated in just a handful of names. And lastly, if you go to the next level down, look at the Russell 2000 small cap index. And there's an argument to be made that is a better indication of economic cyclicality. Those stocks are actually down from where they were in early March right now. They're barely up from where they were in 2019 as well, too. So what's the message of the economy if those stocks are not really moving forward? And the last statistic I'll give you on this about how upside down everything is, the Russell 2000 has a total market cap of about $2.4 trillion. Apple's 3. Yeah. Apple is larger than the entire small cap universe, which is unusual, to say the least.
That's just that they're sleepy.
As I think about what you're talking about, the feudal society and everything, there's been all of this focus on this labor shortage. Right. And I'll let anyone jump in on this as well. We've seen participation come down, the replacement of workers, early retirees. Is this going to ultimately continue to put pressure on wages? We got new JOLTS data today here on January 4th, right, where we see a lot of quits out there, a lot of people going to new jobs. So, Jim, you're chomping at the bit. Rosie, I'd love your take on this as well. So let's talk about the labor market. Start us off, Jim.
Let me posit something, and I'd like to hear everybody's comment on this. The biggest event of this generation was we sent everybody home for now nearly 2 years. It has changed a lot of things that we don't understand. There is a perception on Wall Street that, oh, if X happens and Y happens, we're going to go back to 2019. We're not going back to 2019. I'm not saying it's going to be bad. I'm just saying that whatever is the new environment for work, whatever the new environment for the office is to be determined. And I think when we look at these quit rates and when we look at the change in the labor market, that labor has more control over management, over wages and everything else, that there is a fundamental change that's going on in the economy. So when we talk about what's going on in labor, I don't think any of us know what's going on in labor. I just think we ought to start with, it isn't 2019. It isn't going to be going back to 2019. We're here in downtown Los Angeles. I live in downtown Chicago. I don't know when we're going to get back to the point where you're going to have to wait 20 minutes at the Chipotle across the street to get lunch again, if that's ever going to happen.
There isn't any Chipotle across the street anymore. There's nowhere to get anything to eat down here.
The ecosystems around urban centers have been decimated.
And that's why, so what I wanted to say was, I think things have changed. I know those are dangerous words to use in the financial markets. This time is different. Yeah. But we sent everybody home for 2 years.
We did.
And that has changed things in ways that we don't really understand.
Well, again,
Okay, so let me take this concept of wages that we've been talking about and talk about one of the areas that's been problematic, and that's housing, right? You'd mentioned that a little bit. I think, Jim, you mentioned a piece of this too. But we're talking about wage growth, yet the younger cohorts are running at high single-digit growth. We talk about the middle cohorts just really aren't showing much. But I look at Case-Shiller indices, look at FHFA indices. They've been running year over year north of 20% roughly for a while now. We look at rents, whether it's the Zillow data, whether it's imputed rents, not from the Fed, of course, not from OER. But as you look at that, how does the worker survive this kind of area too when they can't keep pace not only with the asset price on the house side, but even the rent side of the equation seems to be really skyrocketing. And that's not just the year over year. looking cumulatively, let's say, since DEIS-19, right? So, Jim, why don't you walk me through thinking about the housing market? Is it frivolous? Are we back to kind of different, things we saw of the reckless behavior of 05, 06? It's a different kind of strata in there now. But what do you think about the housing market, and how do you think about its impact on the overall economy right now?
Well, a lot has changed in the housing market, in the pandemic. If you take the Case-Shiller data, you look at what they've called the COVID migration. Look at the home price gains in New York versus Miami. Miami is greatly outperforming New York, and that is everybody's moving, is what's happening. And you can see that in a number of places throughout the way that the housing market is changed. The other thing that's changed in the housing market is the prices. In 2002, 56% of the homes in the United States were trading at under $200,000. That category is effectively zero today, right now. You can't really find, I'm talking about new homes. You can't find new homes now that are being built under $200,000, at least at the single family level. So there's been another, like I said, when it comes to work, that we won't know for a long time what the new normal is, and it's probably not going to be 2019. I think when we talk about housing, it's something similar to that. We don't know what the new normal is for housing, but it's definitely not going to be 2019. But what housing has also done is, if you break down wealth categories at the very high end, they are enjoying gains in financial assets. Right below them, they are enjoying gains in their home price right now.
And there's typically more homeowners than there are necessarily stock owners, let's
That's
say.
exactly right.
Yeah.
And so when is my first comment about 40% rent and 40% of less than $1,000 of savings, and they're very unhappy about inflation. Well, right above them is a bunch of people that aren't seeing their paycheck keep up with inflation. But holy crap, look what my house did. So I'm okay with what's happening with inflation. And at the very top end, it's, wow, look at what my stock portfolio did. I'm okay with inflation as well, too. So it's changing a lot of the dynamics in the economy as far as how I think that how housing is impacting it. And for the upper 60%, I think that they're okay with what they're seeing right now. But it also then does drive a bigger wedge in the inequality debate that we've had in the economy.
We've seen the movie repeatedly, and every time the movie plays, ever since basically 40 years ago, it takes less and less of a Fed funds level to make the economy buckle. I mean, the last one, it took only 2.5% or so. And my theory is, based upon what's been happening in the bond market over the past several months, is it looks like it's going to take something like 1.25 to break the economy. And so,
I don't know.
Rosie,
I don't know that they get there.
I completely agree that everything is balanced on these negative real interest rates. These are the most negative real interest rates we've seen, especially when you throw in the quantitative easing and the stimulative effect of that, which is another Atlanta Fed study by Wu and Shi that say that they try to do a thing like, let's pretend that we didn't do QE, but instead went to negative Fed funds. What would that negative Fed funds have to be to equate? And of course, this is academic, so it's don't put too fine a point on it. But it shows that the Fed funds rate with the QE that at its peak, which is now diminishing, it was almost negative 800 basis points on the Fed funds rate is where you on the real Fed funds rate. And when that goes up, I mean, the one thing about the stock market, which I agree is loaded with speculation, as is everything. The one thing about it is if you keep rates where they are on, say, the 10-year, stocks aren't actually expensive by historical standards. But if that rate goes up, they become very expensive very, very quickly.
The terminal funds rate right now, if you go with the market's measure, is around the market measure is around 165, 170. The Fed's latest dots are around 250. So the market is thinking that the terminal funds rate is going to be much lower. Now, what is that? That's the rate at which they stop raising rates. But let's remember the history of the Fed. They are very, very skilled at raising rates too much and breaking something. So the market is kind of telling you that at the outset, at the upper end, about 170 will do it. And Jeff, you're right. 2 3/8 in 2019 broke the repo market. And before that, it was 4%, around 2007. So that number keeps coming down. And that's why I think that the take in the yield curve is Rosie mentioned, we're starting off with a yield curve half the level that we usually start off the yield curve with when the Fed starts tightening, is that I look at the long rates as not so much as being a metric of what do we think about inflation, but what do we think about the market, the Fed breaking something. And the signal that you've gone too far in the market has always been an inverted yield curve. And starting at 80-ish, 90-ish basis points, 2-year, 10-year, the expectation of 3 rate hikes, the Fed is under enormous political pressure to do something about inflation. So it's not just, an issue of, hey, we can't touch the stock market. We got to do something about these other 40%. Couple of rate hikes, a little bit of rally in the 10-year. You're inverted by the middle of the year.
I don't know why.
I'm going to talk a little bit about market structure and how much it's changed. The ETF is taken over. The public thinks the stock market is SPY, which is the S&P 500 ETF. You're either in or you're out. Now, if you want to get fancy and do something else, then you've got the FANG stocks in options. And we've actually had an unusual circumstance, unprecedented, that we've seen consistently stocks like Tesla and Apple trade more options than the S&P 500 trades options as well, too. And that those options now, the FANG stock options, make up the majority of trading in the options market, even though there's 2,200 stocks that trade plus all the indexes as well. So how does the market trade right now? It's a money flow argument. Everybody wants in, they buy SPY. Everybody wants out, they sell SPY. If you want to get fancy, a couple of stocks here in the options market, and that's it. Stock picking is a dead art form at this point. And the active managers that do it in total haven't helped their case because about 80 or 85% of them have underperformed for the last 10 years. So when you look at it from that perspective, then the question is okay, where's the next big wave of money going to come from, push the market up? Well, where did it come from over the last 2 years? Excess savings is a phrase that economists have used. They looked at the savings rate, the trend of the savings rate till the pandemic. And then during the pandemic, we had this huge bulge in savings, and it came from 2 places. One was we spent less money in the lockdown, and we didn't see our wages fall nearly as much, so we had excess savings. And the other one was a bunch of stimulus checks. In total, we had about $2.5 trillion of excess savings come into the economy. Now, since the last stimulus check went out, the $1,400 American Recovery Act stimulus check in March, that money went into largely 2 different places. One, it went towards goods, stuff that's now sitting anchored off the port of Long Beach right now.
Which means it wasn't produced in the United States.
Yeah, it wasn't, but yeah. And the other one was it went to the market. That excess savings number has essentially dried up now. The trend of savings is pretty much back to pre-pandemic levels. So if we are in a binary buy SPY, sell SPY market, maybe playing around a little bit with options, where's that next tidal wave of money coming from? Okay, well, if we have a big lockdown and people stop spending, there'll be a bulge of savings that they could put in the, because most people think savings is SPY as well too. Or if we ever got to the point of talking about another stimulus check, but we're not doing that. We're not even doing the child tax credit at this point, let alone another stimulus check. So the big push that I've seen in the money argument is petering out at this point. It's not reversing. It doesn't mean a bear market alone, but it does mean that the big push that the market has gotten is running out. And the last thing is, that argument, I think, helps to explain the narrowness of the rally, because you had an unusual circumstance in 2021. If you take the big 6 indexes, the Russell 1, 2, 3000, the NASDAQ Composite, the Dow, and the S&P was the best performing of all of those. It almost never is, and when it ever was in the past, it was in a decline, because everybody rushed to quality. I don't want to touch the 2000, small cap stocks when everything's falling apart. But this was in an up 28% year.
That's the Tesla effect.
Yeah, it's not only the Tesla effect, but it's just buy SPY, buy Tesla. Don't confuse me with this cyclical stocks. Get away from me. It's buy SPY, buy Tesla. That's really the only argument that everybody had. And if that's why you've seen that market push. So if the money is kind of drying up, I think the market's going to have a more, as we move through the year, a more difficult time to find the flow numbers to keep coming unless something dramatically changes.
Yeah, Jeffrey, Jim, you mentioned something earlier about, the Russell 2000, the proxy for small caps out there, and it just not doing anything similar to its large cap and mega cap counterparts. A lot of research has been done on the private markets, right? So I think of private equity, where they just say it's really just levered small cap, right? But when I look at things from the private equity market, the VC market, I see very strong performance there, right? So is that relationship different? Is something happening? Is this just the flow of money again, like Ed talks about? It's just capital going into the asset class. How do you think about what's going on in the private markets now, especially with there being fewer IPOs out there? The SPAC has been the other vehicle. So what are you thinking about on the private side?
Well, the big difference between, say, the Russell 2000 and the private market is the private market right now, as we described it, especially when you get into SPACs, is startups. So these are new companies with very high growth potentials. Where in the Russell 2000, a lot of these companies are more established, cyclical kind of companies. If they have any kind of growth, they usually graduate to the Russell 1000, and so you don't get a whole lot of, or only fleeting, real fast growers into that space.
As you know, we have a product that focuses on using the CAPE ratio, and I got that question from investors all the time. Why don't you do this with small caps? Because the problem with small caps is that they usually stink. They stay small cap for a reason. It's exactly what you're saying.
Play.
Otherwise, they move up, right?
Right.
So,
right.
Yeah.
Exactly. Yeah. That they would actually wind up doing that. So what you have in the small cap space is more established cyclical kind of companies. And that's why I also made the statement that they might be a better tell as to the market's signal about what it thinks about the economy, where the small caps are going. There's not as much ETF flows. And if they are more cyclical, it's telling you whether or not they think that the economy is going up or down. And right now they're kind of meandering sideways for 10 months or so. So they're not really giving you a whole lot. So I think, though, getting back to the private market, the other thing about the private market, too, and I'll say this carefully, how do you value that stuff? You put your own number on it, and stuff. Yeah. Hey, guess what? We just went up again. We did a Series C, and we put a valuation of X on it, and one guy bought the Series C, so the whole universe gets revalued, much higher.
You sound cynical.
Yeah, forgive me for being so cynical about that market. The one quick thing you mentioned about SPACs, I think that there's the signal coming out of SPACs, because what is a SPAC? Other than it, in English, it is a pile of money looking to buy a private company. It's late stage venture funding is what a SPAC is. And why did we create late stage venture funding? Because at those last stages, you get in, ramp the stock up, IPO it, walk away with a big profit. Everybody wanted in, so we created the SPAC so they could get in. And what have SPACs done for most of 21? Performed horribly.
Right.
Yeah.
And so is there a market signal there that maybe private is at a top, or maybe even a little bit on the downside of a top, because their proxy in SPACs have not done that well for the last several months?
Yeah, we.
In a market we haven't mentioned the word yet, in crypto market, if you ask people in the crypto market what's going to be the big driver of 22, the first thing they say is, what's the Fed going to do?
Yeah.
That quantitative easing just drives, or the lack of it, or the increase of it, or decrease of it, or the surprise of it, or the expectation of it, so drives traditional markets. It drives that market as well, too. It just drives so much.
And of course,
I mentioned the other side of that equation when talking about commodities was the dollar. right? So how do you think, Jim, how are you thinking about the dollar's position in the really the hegemony we've seen, right, of just the dollar itself? And also just as we look at this kind of relative performance, relative rates, how are you thinking about various currencies around the world?
A couple of things as far as the dollar. You're right. The dollar has a couple of roles. I mean, other than the textbook version that it is the reserve currency, it is the flight to safety instrument. We saw that in the first quarter of 2020 when everything hit the fan. I didn't know what was going on. Get in the dollars. Right. And then we'll figure out what's going on after that. If you're a foreign investor, if you're an American investor, you're already there.
And the corollary is obviously treasuries too, right?
Right.
So it's a
exactly.
Right?
Yeah. Exactly.
That's how you get dollars.
Yeah.
I'm sorry.
That's how you get.
That's
dollars.
how you get the dollars, right?
Yeah. Yeah.
Means of exchange.
And so there's that the dollar is going to be whenever anything gets unstable. So to Rosie's scenario about a giant fiscal drag coming in the second half of the year, if that is indeed the scenario we see, there could be a bit of a bid to the dollar only because it creates so much uncertainty for everybody else. I don't know what's going on. I got to hide somewhere. I mean, I'm certainly not going to say, oh, the U.S. is slowing down, so wave in some more yen. I mean, I'm going to go to the dollar as well too. The other problem the dollar suffers from is, we refer to it as the competitive devaluation, but now that competitive devaluation is taking on a new term, how does it relate to commodities? How does it relate to real stuff? Oh yeah, we could play the game of, are we more or less valued against the euro or the yen or the dollar, but we're falling way behind when we value it in real stuff as well too. And so looking at it from that perspective, I think the dollar is going to continue to be a struggle because the alternative to it is going to be, stuff will continue to do better. Finally, since you brought up the dollar, we can't let this one go. There's another alternative to the dollar, and that's crypto. Because in some respects, it is supposed to be a new reserve currency, or it's supposed to be a competitor to the dollar. It has, over periods of quarters and years, cryptos has been a superior investment to the dollar. It does have horrendous bear markets. Crypto does as well too. But I do think that will also start to play into this equation. And let me tell you how it will play into it. We were talking about commodities a second ago. There was one outlier in the commodities sector that lost money last year. Gold, precious metals.
It's silver too, yeah.
Yeah,
right,
precious metals. They've got big competition in the digital space. Mm-hmm. And that is, I think, a real problem for, why would you buy boomer rocks when you can buy digital gold? And that's really a problem that I think that the precious metal space is having as a result of the adoption and the acceptance of cryptos as well too.
Or a digital ape, right?
Right.
When it's really
what great thought leaders all of you are. Ed, David, Jim, Danielle, Jeffrey, you guys are all just great thought leaders to bring us together. But let's pull it all together. Let's give the clients what they want. Let's give the people what they want. I want to hear what's your best idea for 2022. So thank you. Jim.
I'm going to agree with Rosie about a policy mistake coming next year. And I'll go back to what I said at the beginning. The Fed is under enormous political pressure to at least appear to be doing something. The last thing they can ever do is say, don't worry, it's transitory. Hey, the stock market's going up. Sorry, you only have $1,000 of savings and you have to spend more at the grocery store. They're going to do too much. So flattening yield curve would be story one. Potentially second half, an inversion of the 2s10s curve is my first one. Second one, we talked about this earlier. I'll agree with Rosie. There's a high cyclicality to value versus growth. Value stocks had their worst 10-year period ever until their low in late 2020 before they've rebounded. They completely decimated the whole idea of being a value manager at some point. I think from a mean reversion standpoint, the return of value relative to growth that began 18 months ago will continue through the year. I only hope that that's not a call where you lost less in value than you would have lost in growth. That could very well be the case, but I think from a relative performance that the value stocks will continue to do better. Lastly, I would go you one step further. I am a long-term hodler. I believe in the digital space. I think the digital space is going to be something that is going to have to be reckoned with from the traditional financial space. But I think what we've seen in the last several months out of the digital space continues, and that is sideways to maybe down. And it's going to be a frustration for people as we move forward from here. If I give you one quick positive about the digital space, more money came into digital VC money and startup money in 21 than every other year combined. What does that mean? That means if they have another major bear market in digital, they've got the firepower to keep innovating, keep innovating, keep doing new ideas, keep the space moving forward. It isn't just we only work if these tokens keep going up in price. They've got the ability to keep going. That's kind of what happened in 2018 too. There was a bunch of money came in through initial coin offerings in 2017. The sector blew up. But a lot of the stuff that has been powered DeFi, for example, was created in that bear market from those initial coin offering money and stuff. So I wouldn't be surprised if the frustration sets in on digital or crypto. It doesn't do anything, maybe trades a little bit sideways. But long term, I still think it's definitely a good place to be.
Sounds like you want to be short Lambos too then, right?
Yeah.